Hey friends, Lucian here with the Bullish Bears team. Wanted to make this video on how to manage risk in trading. So this is kind of just one of those things that it's all a matter of kind of your preference when being a trader, whether you're a day trader, a swing trader, a long-term trader. Managing risk is just one of the most important things that you can do. Now, how do you manage risk? What's the proper way to do it? Well, people would say that you want to do a 1 to 2 profit loss ratio. So, meaning like if you're going to risk 10 cents, you want to be able to make 20 cents. Or if you're going to risk 50 cents, you want to be able to make $1. If you're going to risk $1, you want to ideally be able to make $2. Some would say the minimum that you want to do at the very least would be a 1 to 1 profit loss ratio. I don't suggest that. I suggest at least a 1 to 2 profit loss ratio. A 1 to 1 would be like risking 10 cents to make 10 cents or 50 cents to make 50 cents. You don't really want to do that, but I'm saying that's like a worst case scenario. There's other people that don't even realize, when they're trading, they're not even doing risk management. So they might risk, 50 cents to make 10 cents, or they might risk $1 to make 30 cents or 40 cents. That's terrible risk management. But you ideally want to do at least 1 to 2 profit loss ratio, and ideally if you can get 1 to 3, 1 to 4, 1 to 5, that would be even better. But the whole point of making money in the stock market is you obviously want to make money. So you don't want to be putting out too much risk for not enough reward. So for instance, like I'm just going to pick random stocks here. Let's say you were going to get in on GCAP here, right? I have showing right here like a level of resistance, right? So you'll see right here, if I was to get in at the break of 736, there's some potential resistance around 750 to 760, right? So give you an example, if I entered here at 737, knowing, just say 736, 736, knowing that there's potentially resistance, let's say at 750 or 760, I'm going to say at 750. There's a chance to make 14, 15 cents there before I hit resistance, right? So if I was to get in this, and I risked just this area right here, so let's say I got in the break of 736, thinking I could make, let's say, 15 cents, then I got to ask myself, well, what's the risk? What am I willing to risk? If I didn't have any stop loss in place, again, so let's talk about stop losses. You can do stop losses where you enter the stop loss into the system automatically so that it'll trigger when price falls to that level, or you can do a manual stop loss where you press the button yourself. Ideally, you want to get to the point when you're trading where you could actually push the sell button yourself and not put those orders in the system, because having stop losses in the system, there's lots of debate whether market makers see your stop losses. I'm under the impression, and a lot of other traders are under the impression, that they can see your stop losses and they'll trigger them on purpose. There's no proof per se of that, but the point being with that is, if you can ideally set up the stop losses where you can press the sell button yourself, you're going to be much safer, so that way market makers do not see your stop loss. But the whole point with everything is that you want to have risk management, stop losses, know where you're going to be willing to cut your losses and not just hold, right? So for instance, on this stock here, let's say if it was to break 736, what are you willing to risk? Are you going to risk $7, or are you going to risk an area right up here, a resistance area? Are you going to risk that area instead? See, so if you're looking at 736, if you're going to risk $7 as your stop, that means you're risking, let's say, 36 cents to make potentially 15 cents. That's terrible risk management. But if you were looking to get a quick scalp, 10 or 15 cents on this, and you were going to use 736 if it broke down, that's a very good risk management. Not saying to take this trade per se, but let's, again, just to show you an example, if you could make 15 cents, but you were going to risk less than 5 cents if this broke down, 5 cents to make 10 or 15 cents, that's good risk management, right? But you wouldn't want to do risking $7 and make, again, a 36-cent move, or you're risking 36 cents to make 10 or 15. That wouldn't make sense. But a lot of traders do that. A lot of newbie traders will come into the market. They just want to just make money and they don't set proper stop losses. And that's where they end up losing and blowing up their accounts. The fact of the matter is 90% of traders will fail. That's just a statistical fact. So if you want to overcome those odds, it's the most important way to make money in the stock market. One of the most important things to really, really let sink in is having proper risk management. Risk management is one of the most important things that you can do above learning technicals, above learning fundamental analysis. All of those things are great, but if you don't have proper risk management skills set up from the start, you're not going to be a profitable trader. It's all about the long game. It's about growing your account. If you're a day trader, again, most day traders, they still, even the top ones, still make, only successful trades about 60 to 65% of the time, which means 35 to 40% of the time, no matter what, you're still going to lose on your trades, even the best. But the best traders, the reason why they succeed is they have good risk management strategies. So if they're looking to make 20 or 30 cents, they might risk 10 cents, right? Or 15 cents. If they're looking to make $1, maybe they're only going to risk up to 50 cents or less. So that way there's that 1 to 2 profit loss ratio. Again, it's all about growing your account, not blowing up your account. And if you don't have proper risk management, you will blow up your account and be a statistic like 90% of the traders that are out there. Let's take a look at just a couple other ones. I'm just picking some random stocks right now. Perfect example here. So MRNS, right? So you see price is closing right below $6, right? So let's say you think that, come Monday morning, I'm making this video on the weekend here. So let's say come Monday morning, you think MRNS has a chance to break $6 and go up, right? And whole and half dollar amounts are psychological resistance points, never mind candlesticks as well. So anything like 50 cents, $1, $1.50, $2, $3, $3.50, $4, $4.50, those are all psychological support and resistance areas. So there's lots of profit taking that happens at those areas, and there's so that's those are usually huge areas of resistance, as well as when price falls down to those levels, those become huge areas of support. So for instance, let's say you think, or with doing technical analysis, it looks like come Monday morning, MRNS might break over $6, right? Well, before you enter that trade, you got to ask yourself, how far can MRNS run? If you're going to day trade, again, it all matters. It doesn't, whether you're doing day trading or swing trading, doesn't really matter. You want to see, if you're doing day trading, you want to see how far it can potentially run that day. You don't know how far it's going to run, but you want to have a target area. Could MRNS get up to $7? Is there, room for it to run up there? So if you're like, okay, well, MRNS has a chance to get up to $7, is at $6 now. So there's, let's say, $1 potential that it can run, right? Well, then you got to ask yourself, well, how much are you willing to risk to make that dollar? If you don't have risk management set up on that, then MRNS could just tank. You don't know, right? You could just hold on to it. Whether if you're day trading or swing trading, again, that it's different, with intraday, but it doesn't matter. Meaning if you were to get in that position, the stock just drops. When are you going to press sell, right? Ideally, you want to press sell, but again, if you're putting a manual or a stop loss into the system, right below $6, let's say, and the price jumps up to 604, so many times price will drop right down to 595 again to trigger everybody's stop losses before it goes up. That's why ideally you want to press the sell button yourself and not have stop losses into the system, because it happens all the time. They trigger stop losses whether they know it or whether they know what traders are doing. Many traders, they put their stop losses at or below whole and half dollar amounts, and again, stocks will just drop down to trigger the stop losses and go. right? And then it'll take off. So on, MRNS, if you're thinking it's going to break $6, then to make $1, what are you willing to risk? You could, if you wanted to, right here, you can see some resistance around, let's say, the 550-ish area. So 50 cents, if you're willing to risk it going down, 50 cents here to make $1, that's still a 1-to-2 ratio. Even better, what I would do with a stock like this is, because it's at a whole dollar amount, if it were to break and then fail, that's not a good sign. So I might be willing to risk 5 or 10 cents on this one, because if this breaks down below $6 again, that's a very bearish sign. So if I have a chance to make $1 and I'm willing to risk 5 or 10 cents on that, that's very good profit loss ratio, or that's really good risk management. Just getting in on the other side of a whole or a $half amount, maybe have like a 5 or 10 stop below it, one that you would manually press and not just have enter in the system. Ideally, that's good risk management. So I'm not saying to not put orders into the system for stop losses, because sometimes you can't because you're working or something like that, but just be very careful and very cautious of it. Just knowing that market makers could trigger or drop the price down to those levels. But if, again, if you are going to put the orders in the system, make sure that you have a good window of profit, and you have a good, at least at minimum, 1-to-2 profit loss ratio. Let's take a look at a couple more here just to see here. Let's see if there's another one that might look good here. Okay, perfect example right here. You can see there's some resistance right here on TNTR. You'll see 1, 2, and then a third area, kind of rejection, 3 areas of potential resistance. Now this is at like kind of like a weird area, 366. It's not at a whole or a $half amount, right? But you can see it's struggling to get over this area. So now, if you believe, with doing the analysis here, you can see it can get up to $4 and maybe $4.14 before you're going to hit some resistance. So I would probably think on $4 before even $4.14, because $4 is going to be a huge, still a psychological resistance area. So now if price can break above this 360, 68 area, to get up to $4, 368 to $4, that's a potential of, what's my math here, 32 cents, right? So there's a potential to make 32 cents before you hit resistance. Now, you got to ask yourself, if you're going to risk to go that route, whether you're day trading it or swing trading it, you got to ask yourself, what are you willing to risk? Are you going to willing to risk, this thing could fall all the way down to 278. Are you willing to risk, almost $1, let's say 90 cents to make 34? Are you just going to let it sit there? Or are you going to have a proper risk management with a proper mental stop in place to get that potential profit target? What I would do is I usually look at other sides of basically what I do is I like to look for areas that are key resistance areas, and if those areas break and then fall below it, I'm usually out. I might have a 5 or 10 cent buffer, and that's usually it, because I like to keep my losses tight, or my losses kind of very small. So on this area here, if it were to break 368, if this fell really right below this, I'm usually out. I have very tight stops. I might only have 2, 3, 4 cents on this thing, because if it's you can see 1, actually 2, 3, almost 4 times it's struggling to break this area. So if it's breaking down again, this could just easily just drop, right? And it's in between moving average lines. So when I'm going, if I'm thinking that this breaks and it could go up to $4, and I'm only risking, 3, 4, 5 cents to make 30 to 40 cents, that's great risk management. That's at least 1-to-2 profit loss ratio. But the reason why I want to just kind of stress this to you is that the most important thing that you can do is just really set up your risk management from the start. Always, always, always have your exit strategy in place. Know the areas of resistance, know the areas of support, know your stop losses, and know when you're going to cut your loss. If you don't cut your losses and you hold on, to them, it doesn't matter. You could have a 90% success ratio trading, winning 90% of the times, and just hold on to one trade for too long and just wipe out your gains. And traders do that all the time. So if you want to be a very smart trader and a successful trader, it's all about risk management, at least minimum 1 to 2 profit loss ratio. At the absolute worst case scenario, I wouldn't even suggest doing it 1 to 1, but you always want to be able to at least make what you're risking, but ideally 1 to 2 or more. So hopefully this helps you. Again, I have very tight stop losses in place, and I push the stop losses myself, and I just look at key areas of resistance, and when they break, I'm usually out. So again, something like this, I'm not going to risk, hey, I'll wait and see if this is going to go back up. If this goes and it falls, I'm out, if that makes sense to you guys. So yeah, so that's really risk management. You have to define your own risk management strategies, whether you're a day trader, swing trader, long-term trader, it doesn't matter. Again, it's all about, with trading, support resistance. When a resistance area breaks, when a resistance area breaks, that now becomes support. If that support area breaks, that's usually a bad sign and usually a trigger to sell and not hold any longer. Now, many times there'll be fake outs where a candlestick will drop 1 or 2 candlesticks below it and then it'll continue forward, but many of times breaking those areas, it's a sign of failure and a sign to go out, to get out. And always make sure you're taking your profit too. Don't get too greedy. Be aware of resistance levels. Take your profit. Many a times, you gotta, when trading, you want to look at all different things. You want to look at candlesticks, moving average lines, support and resistance, level 2 time and sales, and level 1 as well. And make sure that you're taking your proper profit along the way and not getting too greedy. Again, that's all part of risk management. Whether you're a day trader, swing trader, long-term trader, doesn't matter. Look at areas of support and resistance. Take your profit. There's always times to get back. There's always periods of re-entry that you can get back into a stock. But if you want to be a successful trader long-term, regardless of what type of trader you are, risk management is absolutely key.